If you're like me and want to store as little paper as possible, tax season is an excellent time to pare down your files to the bare essentials. Whether your system is entirely paperless, I'm getting there, or you have boxes and cabinets stuffed with mystery documents, it's essential to know what to toss, what to save, and how long to keep the items that you do save. This podcast will review how to manage your tax returns, financial documents, and other critical paperwork so you follow IRS rules, avoid headaches, and have what you need for future transactions. Welcome back, everyone. I appreciate you joining me for Money Girl episode 898. I'm Laura Adams, an award-winning author and on-camera spokesperson, money speaker, founder of The Money Stack, that's my Substack newsletter, and host of this show, Money Girl, with over 43 million downloads. If you're enjoying the free content that we love creating, take a moment to rate and review the show in your podcast app. And if you've got a question about money, I'd love to hear it. You can leave it on our voicemail at 302-364-0308. You can also visit lauradadams.com to email me directly and learn more about my books, courses, and sign up for the free Money Stack newsletter. All right, so let's get into 5 tips you need to know about which documents you actually need to keep, for how long, and whether you need physical copies, digital copies, or both. Okay, tip number 1 is digitize your filed tax returns. This is something I'm still working on. The IRS allows you to keep digital copies of your filed tax returns and the supporting documents, like the things that back up your income, your tax deductions, and your tax credits. In general, individuals must keep tax returns and all that backup for a minimum of 3 years. And you have up to 3 years to file an amended return or even get chosen for a tax audit. However, you can claim a loss for certain investments for up to 7 years. So if you have complicated transactions like purchasing or selling investments or real estate, keeping that year's tax records for 7 years is wise. While keeping 7 years of taxes might sound like a lot, the good news is that digital files are easy to maintain. So be sure to scan your tax returns or ask your accountant for a digital copy instead of just adding more paper to your filing cabinet. If you have a business, the IRS says you must keep business tax records for at least 7 years, but they can be digitized too. You might use a free scanning app. One that I've really enjoyed is called Genius Scan. You can get this on your mobile device. It's got some really nice enhancement features that allow you to export documents as a JPEG or even a multi-page PDF file that you can email, text, or send to cloud services like Google Drive and Dropbox. Now, if you've got stacks and stacks of paper to scan, you're going to need something, a little bit more user-friendly, like a traditional flatbed scanner with a document feeder. That can be a real time saver. Many inexpensive printers have built-in scanners that will send files to your email. So figure out what's the best and, most efficient way to digitize your documents, maybe starting with your tax returns. All right, tip number 2 is to maximize and document your tax-friendly expenses. I mentioned that you need to keep digital copies of receipts for expenses you claim as tax deductions or credits on your tax return. Getting familiar with those tax-friendly costs can really pay off because they reduce the tax you pay or even increase your tax refund. Let me explain briefly what these are. A tax deduction is an amount that the IRS allows you to subtract from your taxable income. And when you reduce your taxable income, you reduce your tax liability. For example, if your taxable income is $80,000 and you're eligible to claim $30,000 in allowable tax deductions, you only pay tax on $50,000, not on $80,000. So let me go through a few tax-deductible expenses that you may be eligible to claim. There are lots of them, but these are just a few that are probably the most common. There are state and local taxes, including real estate taxes, for up to $10,000. You can deduct home mortgage interest paid on up to $750,000 of debt to buy, build, or improve a primary or secondary residence. You can deduct qualifying healthcare expenses that exceed 7.5% of your adjusted gross income. Health Savings Account, or HSA, contributions up to $4,150 for an individual and $8,300 for family coverage when you have a qualifying health plan. Those are the limits for 2024. And I've done a lot of podcasts about HSAs. If you're interested in learning more about them, please look in the archive. And you can deduct traditional IRA contributions up to $7,000 or $8,000 if you're over 50 for 2024 or 2025, and student loan interest up to $2,500 if you meet certain income limits, and self-employment expenses, including health insurance premiums and contributions to a small business retirement plan. As I mentioned, those aren't all the deductions, but maybe a few that you may qualify for. And a tax credit is a dollar-for-dollar reduction in the amount of tax you owe, and that can be even more valuable than a deduction. For example, if you owe $3,000 in taxes, getting a $1,000 tax credit means you save that full amount and only owe $2,000 in taxes. Allowable credits, such as the Earned Income Tax Credit, are often available for low to moderate income workers and those with qualifying children. Tip number 3 is to keep physical copies of vital documents. While going paperless has many advantages, you should still store certain vital documents because they're impossible or very difficult to replace. Even if you have a digital copy, you want to keep many original records. I'm going to go through a few here, but this is not a complete list. You're going to want to keep marriage and divorce papers, birth and death certificates, adoption papers, Social Security cards, citizenship papers, wills and trusts, medical directives, powers of attorney, education records, immunization records, military records, passports, documents with raised seals, documents with notarized signatures. Also, keep essential documents that you may not be able to get online, such as real estate closing documents, property deeds and titles, promissory notes, documents related to gifted or inherited property, receipts for capital home improvements. So these are things like home renovations, like replacing a roof or installing flooring, that sort of thing. Records on non-deductible IRA contributions, you've got to keep up with those, and your investment statements. Again, if they're not something that you're likely to be able to get online down the road when you might sell that investment. So keep records of large transactions, such as buying real estate, vehicles, and investments, until a couple of years after you sell them. And that may include closing paperwork, deeds, titles, and purchase confirmations. You will likely need those documents to determine important tax information, such as depreciation, capital gains or losses, and to make any amended tax returns. So consider keeping vital original documents in a secure place. It could be a bank safe deposit box or a home safe or a filing cabinet that locks and is fire resistant. For added protection, put your essential documents in an airtight plastic bag and keep digital copies if the originals get destroyed. Tip number 4, manage digital files safely. If you receive documents like credit card statements and insurance policies that you can easily get online, there is no need to keep them either as paper or digital files. Going paperless will definitely simplify your life and lighten your filing or archive load. But for documents that you store digitally, it's essential to keep them organized and secure. Consider saving them in multiple places so your information never gets deleted in, something like a computer crash or a fire. For instance, you might store digital records on your computer, in a password-protected external hard drive, and in the cloud. On your device, you could create a main folder for each year and then subfolders for categories like taxes, investment statements, paychecks, emergency documents, or other information you might need. You can add a layer of protection by requiring a password to access your main folder. And you want to keep your computer's operating system and security software up to date to ward off cyber criminals. Once you store physical and digital documents, be sure your loved ones know where to find them in an emergency. And our last tip, number 5, is to get professional advice when needed. If you're unsure which tax or legal papers to keep or for how long, consult with a professional. In addition to the documents I mentioned here, you may have other records or contracts to keep for business or legal reasons. To sum up, you should keep tax returns from 3 to 7 years, depending on the types of transactions they record. But I'm going to recommend that you err longer and that you keep returns for at least 7 years, especially if you digitize them and they don't take up any space. You should keep the originals of vital records in a safe place in your home or bank safe deposit box and store their digital copies in multiple safe places. I hope these record-keeping tips will help you get organized and cut the amount of paper in your life. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our terrific team. Steve Rickyberg audio engineers the show. Brandon Gaetjes is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.